the most famous and known trader in Italy, partnering up with a 9-time world champion.
When an ICT trader, I've seen some reels recently and they say, liquidity is the driver of markets. So everything is about liquidity. And I'm so agreeing with that. But then they start saying, what is liquidity? So above a high there is stops, below a high there is stops. So they are sweeping. No, absolutely fucking not. Liquidity is everywhere.
Andrea is known for his world-class expertise when it comes to order flow. In this episode, we explore at length the realities of what an order block is, the realities of what a sweep is, and how to use order flow in your strategy.
When price goes above a high, let's say there is stops. In most of the cases I've seen from order flow, I've seen thousands of stop runs. What happens during a stop run is very interesting. Price would maybe... The term smart money is very old. We're talking about the 20th centuries at least. All the concepts of fair value are way older than that. We're talking about Stadelmeier, for example. He's the first creator of the auction market theory model and market profile and volume profile. He was the one that came up with all the analysis of fair value, for example. This stuff has been around for the last 50 years to 60 years. So it's nothing new, really.
When I see, for example, a head and shoulder pattern, I'm not a big believer in it. It's a correlation, not a causation. Do you believe these ways of Waqar theory and others, they are core essences of the market? That's the reason the market moves in smart money ways? Or do you think they're nice reflections of something deeper?
This is crazy sauce. I'm not sure why I'm giving it away like this, but...
Hello ladies and gents, welcome back to another episode. I'm joined by a famous Italian man, I guess in the English market. Not too many people know you, but you're doing English content now and I'm loving it. Bring a fresh taste to the industry. But you have a very interesting story too. And well, Andrea, thank you for joining. A little bit of things that I know about you and then we'll explore your life. But what I remember is you were a typical FX trader in Italy. You have a huge audience, a huge brand, a huge reputation. But beyond that, there's some interesting things that happened where you pivoted to focus on order flow, which a lot of people maybe are not even aware of. I've spoken to a few traders, but I haven't got a full grasp on it myself. But that means you ended up in futures, so FX to futures transition. And now with the life decisions you made and your entrepreneurship and so forth, pivoting from scalping and intrasession all the way to swing trading to have more time. These kind of things a lot of people think about. So like, okay, I want to be a trader, but I can't be on the charts all day long and focus just on M1. And I want to be living a life and doing other things. So I do want to explore how you pivoted and more just getting into depths of the technicals of order flow and exactly your strategy. Yeah. But before we get into all that fun stuff, tell me a bit about yourself.
Yeah, well, hi everyone. Thank you for having me on the podcast. It's amazing. I've been following it for a while now. And this is the legendary setup I've always seen in the videos.
Well, even more legendary is these orange sunglasses.
Yeah, right?
Or not even. Blue light blockers?
Yeah, they're blue light blockers. There we go. So but they're more part of the, let's say, the brand to make me more recognizable, I would say.
Fair enough.
So yeah, I've started trading and getting into trading, like learning the first stuff about it in late 2018. And then I started more actively trading and having my mentor, which is Fabio, which is my business partner in my ventures now, around 2019. Then I've started mainly in Forex and CFDs especially because, you know, Forex is just an asset class. So if I'm defining what do I trade an asset class and one type of contract. So it's CFDs, Forex. This is what I used to trade mostly with what people nowadays are calling smart money concepts. Okay. Fabio was my mentor and he taught me something similar to what now is smart money concepts. He learned from Chris Laurie, which was also the original source of smart money concepts, as many people may know.
Is he... there's a few names that I hear that ICT is obviously the big name right now, but ICT is standing on other people's shoulders, it Correct. Seems. There are forefathers to him, and it makes sense. Like he's now big in the last, let's say, decade or two, but those names before him, who would they be? Is this one of them?
Chris Laurie is definitely one of them. Okay. If we go really back, you would go to Richard Wyckoff, because he was the first one theorizing, you know, everything about market distributions, accumulation, manipulation, what people call now the turtle soup, or, you know, the liquidity grab. He used to call it the spring or the up thrust. Exactly. These kind of things. But we can get into that
perspective. Yes,
we can get into that later on in the podcast. But so I started studying from Fabio, and he was a great trader, and he taught me everything, not only about trading but also about the industry. He was the first one who, you know, I started with kind of like everyone else, you know, we're watching gurus on YouTube with Lambos, and I was like, yo, I need to get into this, you know. But he made me understand the need of studying, of hard work, of discipline, the fact that it's not as easy as they tell you it is. You have to find an edge. You have to maybe back test it a little bit and then forward test it, keep it monitored, blah, blah, blah. So I started getting more like actually profitable and started trading with prop firms. I started with FTMO with a 25K account. I did a couple payouts, then lost it. Then I improved more as a trader. Then I started going with different prop firms like MyForex Funds, True Forex Funds, the prop trading, the funded trader, all prop firms in which I was able to reach 200K in each one of these prop firms as a funded account. And gradually, one by one, each and every one of them defaulted or, failed or was closed by some authority.
Yes.
And so in that period, I started studying futures more and more, starting order flow more and more, because I wanted to get a deeper grasp of also what ultimately smart money concepts are trying to figure out, which is order flow. Because even if you hear ICT speaking, he's talking about bullish order flow or about order blocks.
So it's very interesting to me because I'm on the same side where I'm trading these liquidity graphs and I'm looking for rejection points. And I've always wished, and I've gone down the rabbit hole in FX of like, the volume profile, the volume indicator, just to see, okay, is this wick that I'm seeing, is it with momentum, with volume, or without? And then you start to realize, okay, the volume indicator is just based on the broker or the price feed. So there's no real volume in FX. So we have to use reflections of order flow, like a displacement or a break of structure.
Definitely,
and these kind
but
of things.
I think that's a great way, like for people.
But there is a need for orders. Yes,
definitely. We will definitely go deep into that.
So just to jump, the SMC and what you see today as ICT, would you say they are the same thing or not really?
Honestly, I'm not a huge expert on the terminology, on the definitions, but smart money concepts, like the term smart money is very old. It's very old. We're talking about the 20th centuries at least. All the concept of fair value are way older than that. We're talking about Stadelmeier, for example. He's the first creator of the auction market theory model and market profile and volume profile. He was the one that came up with all the analysis of fair value, for example. So now the fair value gap, it's a gap in fair value, which is when market basically agree on a price. So a fair value gap would be the exit from the fair value, the imbalance compared to the balanced market. This stuff has been preached for the last 50 years to 60 years. So it's nothing new, really. I don't remember where we started
from this.
Comparing
that to, like, let's say, the legacy way of smart money compared to the modern way of the ICT variants, where I guess the traditional SMC didn't have total soup as a thing at all. Maybe there's a derivative of it and he's relabeled it or reworded it. Do you see much difference in your way of trading initially, which was SMC by the forefathers, let's call it, and the modern way that people trade SMC?
It would be similar. It would be similar in some ways, definitely. I mean, I wouldn't say that the names we were giving or the strategies or the entry model we were using are exactly the same, but they were revolving around the same type of understanding on financial markets. And
do you think that evolution makes sense when you say these terms and these ways of looking at the market are 50 years old plus? I also think everything in the world has changed in those last 50 years, technology-wise, and phones and everything internet-related. So I imagine people's behaviors have changed, accessibility to the market has changed, and therefore the market has changed in its formats. Would you agree with that?
100%. If you think about Waqar, he was using daily candles and writing candles down physically on a pieces of paper. So it's like we're in a completely different world. He understood the concept behind it, the logic behind it, but what happened now is trading got way faster also. Before you used to call a phone to make a trade. So nowadays, I think you can find the same pattern that Waqar was preaching in the daily or the weekly time frame in the lower time frames, because the speed of trading has gone so much up, but the physiological needs of big operators to fill their orders are still the same. So nowadays, it's like you're having this microscopic version of the Waqar accumulation and distribution patterns that now people call turtle soup, or two liquidity grabs, one liquidity grabs after another, SMC traps. These are all things that after we can go deep into the order flow mechanics behind it, of course, but definitely I would say that there is some signs of these modernized version of things that already existed.
So I got two questions here. So one thing is, a lot of traders get caught up in the labeling game and trying to just mark things correctly and not realizing that maybe they're all the same thing. And what I mean by that is, when I'm comparing a head and shoulder pattern, which is just left, head, right, that can look like a distribution from a Wyckoff theory
Correct.
perspective, just a bit more detailed.
Correct.
And then you can probably have an ICT variation of that with its own turtle soup name. And then I can justify it in another way because I'll be looking at something else more sweep related and rejection related. Point being, we can all see the same price action and one person marks it as a head and shoulder, another person marks it as something else.
Correct.
This labeling game, do you think when people do the labeling game down on the lower time frames where you're using a Wyckoff distribution, which was daily candle prints in its origination, now being done on the M15, M5 and these kind of things, do you think it's just people labeling things and it just coincidentally is aligning, or is it truth in it so that it is a accumulation distribution on a lower time frame?
That's a nice question. I wouldn't say that we're talking about the same thing, because Wyckoff was talking about accumulation and distribution of shares, of stocks. So it was literally accumulating as in buying and distributing as in selling. You're selling those stocks. So it was a long-term, let's say pattern, a longer-term pattern. So I wouldn't say nowadays the same thing is going on, the same thing that Wyckoff was mentioning or explaining. I would say that it's somewhat similar in the way it shows itself, but the reasons are different. And they are not necessarily manipulative, I would say.
So that was actually part 2 of my question, which is people get into the labeling game and sometimes they label it and then price does what they expected. So they're like, I figured it out. My labels were correct. When a lot of times it's more coincidental, or what I usually call is correlated. So when I see, for example, a head and shoulder pattern, I'm not a big believer in it. So when these people see the right shoulder and then it goes bearish, not only the idea of these hedge funds are not selling because of the right shoulder, they have other reasons, and your right shoulder was a nice reflection of that. So it's a correlation, not a causation. Do you believe these genesis ways of Wyckoff theory and others, they are core essences of the market? That's the reason the market moves in smart money ways? Or do you think they're nice reflections of something deeper?
So these are very complex questions to answer in a brief and concise way. I think the best way to figure this out is understanding who is in the market, understanding how market mechanics work, and understanding the reason why price may move. And as you've said, there's hedge funds, there's banks, there's pension funds, there's sovereign funds, there's university endowments, there's actively managed certificates, there's community pools operators, commodity pools operators, commodity trading advisors, there's retail traders. The amount of types of participants that are in the market makes you understand that, first of all, the finalistic view of the market, where something happens because of someone else's benefit the whole time, doesn't hold.
I think that makes a lot of sense, because what you've listed is a long list of speculative participants.
Correct.
But there's also people just genuinely using the currency for international trade.
Definitely.
The market is a sum of so many behaviors,
Yeah.
and we see that reflection in price. But
Yeah.
this macro, like one party controlling,
Yeah,
it doesn't make too much sense
doesn't
when
make
you
much
look
sense.
at it from that lens.
Definitely. And that makes you also understand that the kind of needs of every different market participant are completely different.
So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
Because there's a difference between big money and smart money, for example, in the way I view markets. Because a big money participant like a pension fund is not going to try and get the best feel out of all of every contract they're trying to put on the market. While maybe an HFT firm or a bank will, if they're trying to be smart, as in, let's try to get the best feel possible. While a pension fund maybe might get a big chunk of order of billions of dollars in the same market all at once, maybe trying to feel it below the VWAP if they're really, but I highly doubt so. The point being, pension funds has a way longer time frame of holding their position. They're more investing than actively trading. So maybe some of the pattern we are seeing are some types of market participant trying to influence the market and engineer some level of liquidity, which I don't believe is retails, by the way. They're not
For sure.
They're not hunting for retails for sure.
Yep.
But definitely physiological needs are different based on what kind of market participant you are.
So this is a topic I don't have an answer for myself, and I always try to explore it with a guest, and I don't think anybody truly knows, because I get different answers from everyone. But when we're kind of referencing Waqar theory, and let's use the example of accumulation. Accumulation, in the true sense from a Wyckoff perspective, is over time, the market is shifting from bearish to bullish, and we're entering a new market cycle. For a transition of meaning to happen like that on such a large time frame like the daily, it requires a lot of money to transact. And the reason I think that happens is because one person can't come in and just say, I want to buy at this price at this time all of this amount of currency. So they have to slowly ladder it in when liquidity becomes available.
Correct.
So that display we see of accumulation is the behavior of the market changing. So when I see on a lower time frame, which was the earlier question, I'm seeing that as, okay, why is M15 accumulating? And it looks exactly like the Wyckoff version, and I can label it out. And I think to myself, am I doing the labeling game, or is there true essence in this? And then I fall back on logic. I'm like, well, maybe so, because, okay, we're not talking trillions or tens of or hundreds of billions of dollars, but on the M15, we're still talking a lot of money.
Yeah.
And that guy can't come in and just say, I need to buy at this time, at this price, all of this. So I have to wait for the liquidity to become available so I can pair off my order. So I was just seeing them as like mini versions of it on a smaller time frame, meaning smaller dollar amounts. Transactional. But then I come back to the same point of who is it? Because when you're talking about these major participants, they're probably not microscopically on the M15. They're putting in a big position, taking a few weeks for it to fill, and then waiting 10 years.
Correct. Like the point is here we're not talking about practical implementations as much of opinions, I would say, because right now we're in the realm of opinions. We're in the realm of trying to understand why things happen, which is not always helpful in trading, I would say. Like, I would say that for a rational and logical mind, knowing what's going on and why is it going on is very helpful to understand the logic. But if you're a pattern-based trader, you're not going to give a shit about why is it happening, as long as it's happening with a statistical edge, which is enough.
To be honest, I end up there. I'm like, okay, I don't know why, but I have enough evidence. I can build an edge, so I'll keep doing it. I do the behavior and not truly understand when I see a run of liquidity and then a rejection, and you probably see the order flow behind it, so you can see the evidence there. But the whys of it, I guess we leave it to a mystery. But that leaves a big void for ICT to come in and say, it's the algo. It's the algo I coded.
100%.
And then you're left confused because you can't deny it because you don't know the truth yourself or an explanation.
You can deny it because, and I would argue that there is a level of depth in which you can go with understanding market mechanics. The more you understand the truth of how market works, you understand that it's a very complex mechanism, and you start embracing uncertainty in understanding. You start understanding that you're not going to understand, and that's okay. And if the more labels you try to give, the more you're based on opinions. And this is the whole thing about the ICT space. I've heard a lot of ICT, not a lot, honestly, but some ICT traders, not ICT himself, talking in some podcasts about the algo and how there is central banks, so it's supposed to be a central bank one, but also it's the banks that doesn't have access to it, so it's like above banks but below central bank. That's like a very creative work, I have to say. Okay.
So it's a web. So even the banking system, when you're using SWIFT, let's say you're doing an international transfer, it's not like if I want to send money from myself in Dubai to yourself in Italy, I can't just send it to you. It has to go through a chain, and the SWIFT is a chain of like, it goes from my bank to then a central bank to then across, and there are mechanics. A lot of banks even, like, let's say we're doing inter-Dubai transactions. Let's say I send you to your bank account in Dubai. It's not a case of I send you $1,000 and then you receive $1,000. What will happen is the banks will sit and say, okay, what are the transactions between both of these accounts? What cancels out and what's the left? This bank owes $10 million to this one, so they transfer the net,
and they're using
and they balance the books.
And you're using bank reserves for this,
Exactly, and then you introduce fractional reserves, and you see how they leverage it up. Let's say the banking system is super complicated, super weird, and non-intuitive. So when I see these kind of hierarchies of central bank, intra-bank, retail bank, whatever, and then all of these are liquidity providers and whatever, the web, I don't know what goes on. But what does make sense to me, in theory at least, is when I see the idea of participant, don't know who, wants to buy a large amount of a certain currency, they cannot just dump that into the market. We can, as CFD, first of all, we have an insignificant amount, but second of all, we have a contract for difference. There's no live execution. But when there is live execution, it's a bid. It's a bid. You got to have a buyer and a seller. You got to match them up. So I can imagine that transaction that happens to say, I want to buy X amount of this today. I'll put that order into the liquidity provider. The liquidity providers do their thing with the web of banks, and they'll slowly give you the amounts that you need.
You're talking about
CFDs
fills. Right now, right?
No, I'm talking about real. Like CFDs is just a simulation.
Mostly,
it's not real.
Mostly, it's broker acting as a liquidity provider, as a market maker. If you want to get deep into how these kind of market mechanics goes, you have to, and people at home has to understand the difference of kinds of liquidity that you have in the market. So you have two kinds of liquidity. It's not buyers and sellers. It's passive and aggressive. So you have the menu of the market, the catalog, the offer of orders, buy and sell. So we're not making a difference right now between buy and sell orders. So you have to see the market as an auction. That's why we're talking about auction market theory. There's the goods sold at the auctions, the paintings and the statues and everything. And then there's the auctioneer, which is the exchange, and all the bidders, which are, pushing price higher every time they make a new offer and they make a new bid for the products that are offered. So buy and sell orders would be in the order book, and those are the supply of orders, of liquidity. Then there's aggressive market participants, which is people pushing the buy and sell button, so buying market right now, or stop orders. Stop orders are part of market orders because order book is made of buy limits below, sell limits. So those are limits, and you basically, when you buy from the ask. When you sell to the bid. So what moves the market is people accepting to be filled at lower or higher, worse prices anyway, in order to get filled. So it's not about there's more buyers or sellers in a buy candle or sell candle. There's always the same amounts of buyers and sellers. In a buy candle compared to a sell candle, the only difference is who was ready to accept worse prices to get filled because they wanted to get filled.
And you're talking about CFDs right now.
I'm talking about futures regulated market that moves.
Okay, so when you explain the difference between the bid and the ask, that difference I understood as the commission of the brokerage, and that's kind of how they make their spread. That's their money in the middle.
Also, market makers are having the same business model. They quote the bid, they quote the ask, and whenever there's a transaction that goes sideways, they're earning a lot of money because of the bid-ask spread, even if it's very small.
And in this sense, you're kind of differentiating participants of buyers and sellers between active executions versus pending orders saying, I'm willing.
Correct.
And that willingness is also graded, not just on size of the contract, it's also the willingness to pay a worse price.
Correct. The willingness to pay a worse price is actually in the aggressors. Because if this is the best level, there is a buy liquidity. And this is the best level where there's a sell liquidity. If you're going to buy from a slightly higher price. If you're going to sell, you're going to have to sell to a slightly lower price. If you're buying market or selling market. If you want, you can place your bid there, your buy limit there, but you're not guaranteed to get filled. So you're going to get filled only if there's someone who is acting as a counterparty to your trade and who is aggressively selling on you. So you are saying, okay, there's someone who's going to sell on my order. Then I get filled. So this is the main difference. And the cool thing is, for example, with news. With news trading, people think there must be a lot of volume, there's a lot of volatility, a lot of liquidity. That's partly true. What happens is, in most markets, and you can see it in the CME website, everyone can go to the CME website and look at matching algorithms. If you get deep into market mechanics, it's very fascinating. Because you will see there's different kinds of ways they match aggressors and passive participants. One of them is the lead market maker model. And how that works is one or more market participants they have the right to get filled before. Because when you put an order in the bid or in the ask, you go in a queue, which works with a FIFO model. So first in, first out. If you put the order first, you get executed first. So it's a chronological way of getting filled. But with a lead market maker model, at least 40% of the volume that is entered is going to be executed for a specific liquidity provider, for a specific market participant who is acting as a market maker for that market and quoting all the price. So there's like a privilege. There's a privilege of getting filled first because I always provide liquidity and the exchange loves that. What happens is the only time in the agreement between the exchanges and the liquidity provider they are allowed to take off liquidity from the market is one or I don't remember how many seconds before a news release. So what happens during news release actually is the book is empty, is completely empty. And it requires just one contract to be clicked buy. And the first order might be...
Jumps.
And it jumps so quickly. That's why if you look at the OrderFlow version of a CPI candle,
yes,
you will see 0, 0, 0, 0, 0, 0, 0, 0, 0, 1. And then it starts going up and the trading activity starts happening again. But lead market makers are taking out their orders during news release because there's high volatility, and market makers only earns from consolidation period. The more there's volatility, the less they like to be on the market.
I've got so many questions.
Yeah.
Okay, first of all, when you describe this news gap, I want to call
Yes.
it, where there's a void between the last order's pre-news and the first order right after news.
Yep.
That gap, which some brokers just put a body in there or a wick in there, others would actually put a physical gap. Either way, you can call it an imbalance or a gap in the market. One of the first things I think every trader learns is like the gaps always fill.
Yeah.
And therefore, Sunday market open, trade the gap fill or X, Y, Z. When you look at it from an order flow perspective, does that void in orders mean anything?
Not really. That's the definition of a liquidity void. So when there is no liquidity, it's not that there's just one side and there's just sellers. I've heard this say from a lot of ICT traders. It's not like that. It's definitely not like that. There is a part of the candle which has zero liquidity because the market makers pull their ass out of the market. And then at the end of the candle, usually you start having more volume and more contracts being executed. So that gap in liquidity is not necessarily going to be filled. It depends on what long-term traders are doing. For example, if you look about CPIs or NFPs or FOMC data coming out, most of the time, it's not directional. Like most of the time, it's just pointless liquidity. Not most of the times, but I would say at least a 60-70% of the time. But there's a very good percentage of time as well, considerable and statistically relevant, where there is a push in price during the news, especially maybe in indices, and price keep going higher and higher and higher. This has happened all throughout November 2023. You would see data after data after data. The price was keep going up and keep going up because of positive inflation data. Same during 2021 when inflation was, or 2022 where inflation was really high and really problematic for the market. So you also have to understand the macro concept, but the macro context. But if they're going to get refilled or not only depends on what market will eventually agree is the fair price of the day. So if price goes whoosh, and then go down again and refill the gap, long-term traders didn't take any decision today. We're still at the same time we started today. So only speculators, because at the end of the day, a daily candle will tell you the net market positioning, net of short-term traders, because all day traders are gone, all HFT traders are gone. So now you're just left with what are long-term traders doing? That's how they're positioned. Okay. So if during a trading day, for example, during a news day, the daily candle is closing with a full body, that's a very good indication of what long-term traders are doing, for example.
Okay, I'm gonna pin that because I want to come back to when we talk about swing trading.
Yeah.
But that actually makes a lot of sense, and I never even considered it of like a daily candle is the net behavior of long-term thinkers because the short-term thinkers are out. But I think that would be very nice for a swing trader's mentality.
Definitely.
I want to get into this topic that we're talking about of orders. And before we get into how to utilize it from technicals in futures, I want to understand one thing. So we're talking about the behaviors of aggressive and passive orders.
Correct.
And then you have the first in, first out kind of basis of how they're executed. And then you have the exchanges and the liquidity providers kind of matchmaking and kind of orchestrating what people's desires are. They're doing the matchmaking.
Correct.
So when I'm thinking of that, obviously they're not doing that manually. There is some algorithmic behavior for them to reflect their exchanges requests. And when I do look at, let's say, Euro USD, if I look at a single week's price action, I can find, no jokes, 50 plus examples in a single week on M1, M5, lower time frame in general, of this idea of a small consolidation and then a sweep of some direction. Let's say a sweep up, and then price will go down and actually break structure, therefore significance. And I can see that pattern, let's call it for now, repeats again and again. Now, when I'm to think why that pattern happens, what was the purpose of a small consolidation and a sweep, and then the real move happening, as opposed to consolidation then move? The reason I see that is because these people that were willing to pay worse prices, they're like, hey, I'm waiting for this order. The exchange is like, okay, you're ready. Let's shoot the price up to fill you in. And they're orchestrating that and to get the last orders in before a move happens. So that kind of algorithmic behavior, do you think that reflects to anything true, especially from an ICT lens?
Yeah. So being clarified that retail traders don't play a role in this. And it's not my opinion, it's numbers. The Bank of International Settlements in the Forex market, retails are like, they said around 4 to 5%. So it's like insignificant levels of liquidity for the kind of players we're talking about. But if we're talking about intraday, okay, if we're talking about a range and then down, we're talking, I'm hearing a lot of liquidity sweep. What do you think is being swept?
So I think liquidity sweep is not my choice of term. But the way I'm kind of seeing it is that there is a block of orders, not order block, but actually just a block of orders. And the market, it doesn't make full sense for the market to just go without filling as many as possible, especially if there's people willing to exchange. So once that matchmaking is done and every buyer and seller is satisfied in that moment, then price is ready to move. So I'm seeing that consolidative phase as people agreeing on a price, and then I'm seeing that kind of like the auction says going once, going twice. That sweep is to catch those last people in. That's how I justify it, and then I go off the pattern without explanation because I just see price action. I see price action and I see the behavior. I trade that, and I don't truly know what happens.
Definitely. That's why it's interesting to expand in these topics, I guess. And again, we're on the realm not of statistical edge yet. We're just in the realm of understanding market mechanics.
What happens,
So at the end of the day, for traders that are watching, the most important thing for you is finding an edge. So now we're in the realm of understanding and knowledge, and that
the reason I'm hanging around on this topic longer than usual because I always ask a guest just to feel for it. Usually no one has it, but you do. So I want to actually take the time because I've been searching for someone that I can kind of have this conversation with.
But I love going into this. It's been my field of expertise for the last years. So it's also because we're selling OrderFlow software between other things. So I really deeply know market mechanics because I had to understand it really deeply. So back to the liquidity sweep idea. There is a liquidity sweep. I can guarantee there is. Actually, what most people would say are being swept is stop orders. Okay? Like,
not a sell stop, buy stop, you mean like a stop loss, like an exit?
Stop orders. So we're talking about, can be a stop loss or a breakout trade. Like a buy stop or a sell stop.
Yes, exactly.
Only in the CFD space, stop loss and sell stop are two different things. In normal world, in normal markets, those are the same. So you're going to buy market, for example, and put a sell stop as your stop loss in futures market. And in any market. Or you can put a sell stop that's going to break out. It depends on your net position. But anyways, when price goes above a high, let's say there is stops, and in most of the cases I've seen from OrderFlow, I've seen thousands of stop runs, and I have a strategy specifically on stop runs that has the last stress test I did in the prop firm was around a 52% win rate with a 2.2 profit factor, so it has an edge, it's a proven edge. What happens during a stop run is very interesting. Price would maybe go right above a high, or very close to a high, and usually up there is stop orders. It can be stop loss from sellers, so exit liquidity, or new buyers that are trying to come in. Sorry, this is a buy stop. Sorry, above a high is buy stop.
But in the order book, they look the same.
There's no stop orders in the order book. That's the point. In the order book, above a high, you would have sell limits and buy stops. But buy stops are not in the book. The exchange cannot see them. Buy stops are only in the broker. So you would tell your broker, what a buy stop basically means, is you're telling the broker, not the exchange, fill this order when price moves up at the best price you can get.
So it's a trigger to the broker, and then the broker acts when time is ready.
And sends the order market. So it's basically like clicking buy, literally. And so what you're gonna do is your buy stop is gonna take a level from the ask, from the sell limit part. So what happens is what people call a liquidity sweep, because stops are being swept. Actually, stops are the one sweeping the ask liquidity. Because there's so many maybe stops there. It can be one big order, it can be multiple small order. You can understand it with level 3 data. And they're entering market and cleaning up every level of liquidity in the book. And since there's a lot of them being filled at worse and worse and worse and worse and worse and worse prices, because they all come in the market at the same time. So there's a huge spike of volatility only from buyer aggressors that are eating all the levels in the book.
Just to clarify, so let's say you have a supply zone and people are selling, and then right above the supply zone they have their stop losses, meaning buy stop positions. The sellers turn into buyers when they exit the position.
Correct.
So when prices cross that stop loss zone and you're entering that territory of where stop losses could be, as people exit the market, they're actually placing buy orders. And those buy orders that are coming into the market now are shoving price up.
Correct.
Hence the sweep
They are bidding, they're accepting worse and worse prices. So they're bidding the price up. And then what happens is something very interesting. And that's the edge that I found. Also thanks to one of my mentors. His name is Enrico Stucchi. He's an amazing trader. And what happens is there's an imbalance now. Because we had a very quick movement that has swept the book. In the order flow space, what is called a liquidity sweep or a stop loss hunting or whatever, we call it book sweeping. So we're sweeping sell limits, not buy stops. So what is created is a candle which is full of buy side delta, and a full imbalance because now we've swept the book. So all those levels doesn't have liquidity anymore. So now the path of least resistance is to reabsorb the stop run.
As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it. And probably you'll be using it for years to come. So what I see is when you've had all these buyers and prices gone up now, there's no more activity, let's say, because the book has been swept, meaning the sellers have said, there's no more sellers left. Price went higher and higher to see who's willing to sell. It reached a point where the buyers were satisfied. The sellers were like, these are all done. So you have an equilibrium temporarily. With a void below.
Correct. There's a void below, exactly. So we find a balance above. And there's a void below of, now below there should be new buy limits starting to refill the book now, okay? Because we're higher in price. And below price, you only have buy limits in the book.
And that would be people that are trading buy stop off breaks of structure and these kind of...
Buy limits. We're talking about buy limits.
Oh, yes. So pending buy limits based on breakouts.
Maybe, yes. Okay. Or maybe market makers, for example. Because you have to start shifting away from what would a retail trader do with a breakout structure. I would put a buy limit. Most of the market participants are not doing that way. They're mostly almost algorithms and market makers. So market makers will refill that levels of the book that have been swept from the sell side. And now there's a bunch of buy limits, but they're way less. So the path of least resistance now is that one. So market will most likely rebalance this first move up and move down at least back into the range where we started with. That's why there's a spike.
But you know, when price jumps down to fill that void, does that naturally means sellers came in to
Yes,
move the market
correct.
down.
Yes, now sellers kicked in and
Okay.
moved the market down.
So when one of the ways I look at the market, let's call it an M15 for now, I'll see a structural resistance or an Asia high or some form that I will call liquidity pool.
Yeah.
And then when I see price sweep up, it goes up quite aggressively, comes down just as aggressively.
Correct.
Now you're justifying it through voids and orders.
Yeah.
But what I also coincidentally find is I don't look for this. I more retroactively see what happened, and I usually see that sweep that happened, and then price came down. When I see where was the peak of that sweep, and I look left, I'm like, oh, it just happened to be a form of supply.
Yes.
And then I can kind of see, well, now we justify and say price is going up and up because buyers are entering. They're entering until when the sellers are ready to say, I'm ready. And then the sellers take over.
Yes, that's also
So can
true.
you pair this order flow read to traditional market structure supply zones and demand areas?
So I've been using this strategy on stop run on the ES contract on the 1 minute time frame. So it's a completely, like, this is book scalping. This is order book scalping. So I would say in the 15-minute environment, plus if you're talking about Forex, I have no idea about Forex. Why? Because there's no volume in Forex. You don't have order flow in Forex. You can have the order flow of Forex futures contracts, but they are like 1% of the total volume of Forex. Most Forex is Forex swaps and spot market.
Again, just to clarify, so when you say there's no volume in Forex, you're meaning there's no volume visible to us.
Correct. Yes,
But
that's
the
what I
same
mean.
mechanics that we've just described is going on behind the scenes
Correct.
naturally.
Correct.
Yes.
That's why usually if you want to analyze volume activity in Forex, you rely on tick volume, which is slightly different. About it, and the correlation between CFD volume profiles and futures volume profile are around like 80-85%. So they're basically the same. Yeah, the point with volume profile.
Yes.
With order flow, then it's a completely different game. Like you can see a footprint in Forex that you can, but it makes really not a lot of sense in my opinion.
Another thing that you mentioned was in the markets in order flow, you cannot actually see pending orders. You just see active aggressors or passive orders.
You can only see passive order, like the only limit orders you see, or pending orders, is limits, buy limits and sell limits. Buy limits below the price, sell limits above the price.
So when people talk about spoofing and this idea of like there's a pool of orders waiting above, so the market is attracted towards that. That is going to be buy and sell limits, not the buy stop sell stops.
Correct. It's a bunch of buy limits or sell limits, but they're generally not put to attract liquidity. They're trying to put a wall of fake orders there, or ghost orders, that are going to be taken out of the market as soon as the market reaches it, because they're trying to feel something below. So what you usually do when you want to trade a spoofing is you're also looking for a so-called absorption. So in the sell limit, there's a bunch of orders, and then below, there's very few orders that are in the book. But here, there's not a lot of orders actually executed. No one is really buying into them. And if someone tries to buy, they disappear. So they are fake orders. This is spoof orders or layered orders. And then you would see downstairs, all these sell orders are trying to make the market believe that we're going down. And that there's someone big saying we're going down today, guys. And what's happening really in the lower part is in the buy limit side, they're putting a so-called iceberg order. And an iceberg order is they're not the opposite of a spoofing. So they're showing just maybe 10 contracts, but they have ready around 100 or 1,000 contracts. Every time they get executed, they put a little bit.
It's a domino effect.
So it's a domino effect, and they get filled by not showing that they have an order, but absorbing all the selling pressure that they are artificially creating with the spoof orders up. So you would have spoofers here that trades into a trap, which is an iceberg.
Okay. And is this a strategy?
Correct.
Are the big players utilizing spoofing and icebergs as a way of confusing? And if they are confusing, who?
So before Navinder Sarao allegedly caused the flash crash in 2010, spoofing was illegal, but was very widely used by institutional traders and HFT firms. That was a really great case study of how, as long as the big market makers are doing something, it's okay. No one's going to say anything. But if you're a poor Indian guy from Hounslow and you make $50 million out of it, then you're going to get problems. But anyway,
Such is life.
such is life, yeah. And so the whole point of this is market manipulation. It's pure market manipulation. Spoofing is illegal. Iceberg orders are not. Actually, iceberg orders, if you want to hide your order because you don't want to show it to people, because you don't want to impact prices, then for the exchange and for the regulators is okay. There's also different kinds of icebergs.
So why would any institution ever not do icebergs? Like,
They
why?
mostly
What
do
advance? Is there any advantage of saying, "Hey guys, I'm willing to buy so much right now"?
Hell no.
You want to be kind of secretive.
Of course, most of the orders that are executed, you don't see them in the book.
Makes sense.
That's also why the order book is, if you want to become a book scalper, the first thing you have to understand is what you see is not reality, okay? Because most of the stuff that's put in the book is fake. So you have to understand how is it fake and compare it with actual traded volume, and then you will understand how to use the book. That's how all because, people say, but, there's a lot of spoofing, everything is fake, so it's not usable. No, it's just you have to understand.
You have to clean the data.
You have to clean the data and understand what's being executed, because book is just buy limits and sell limits. It's not executed yet. It's just intentional liquidity, but it can be easily faked. So with iceberg, the cool thing is iceberg orders have two types. There's two types of iceberg order. The first one is a native iceberg. So the exchange is allowing you to have an iceberg, and they handle it. They handle the execution of the iceberg. And they have a specific order ID that with level 3 data, you can identify with 100% absolute certainty. So the so-called MBO data basically allows you to see iceberg orders with 100% certainty, because the exchange is putting this order for a big market participant and fractioning it into very small orders. So you can see, where is it? Is it moving? Is it staying in the same place? Is it filled? Is it finished? There's a bunch of information there. Then there is these are native icebergs, and then there's synthetic icebergs. So icebergs which are created by the broker or by the firm, and they kind of create it themselves with the advantage of they're not really seen because it's anonymous. So it doesn't have the same order ID. Every single part of the order is a different order. There's some other advantages, but it's mostly disadvantageous. But there's a lot of stuff. There's a lot of stuff in OrderFlow that is really interesting. But we're talking mainly about scalping mechanics.
Okay, so there's another question that, so what I find is the most important part of the market is usually reversal points, and usually where that happens is, let's call it market structure, supply and demand zones. Just for the sake of simplicity, let's focus on a supply zone. When price is entering that supply zone, and we're talking about the idea of price came to the supply zone, hit the stop losses of people, which is actually just pending buy orders, buy stops. Once those were executed, now the sellers are out of the market. There was a gap left, and then the sellers came in to fill the gap, and then the market went lower. So when you look at that in price action, you will see, okay, price wicked above a supply zone, and shot lower and made the lower low. Manipulation. First of all, I want to see that manipulation, is that an accurate word? And second of all, when price shoots down, that makes complete sense to me. You're filling a gap and the sellers are taking over, and the buyers are out. There's an imbalance. There's more sellers than buyers. But that portion of moving the market up and actually doing the sweep, let's call it, who would do it and why would they do it? Because from a speculator, it makes no sense to buy in a supply zone just to grab that liquidity and then be out moments later. So is that the exchange maneuvering price, or who is doing it, and why is it happening? That portion up.
It's really hard to say.
Okay,
it's really hard to say. Even understanding the depth of market mechanics, you can't be explaining every single market movement that happens. But if you were to say, okay, we're getting into a supply zone and we're trying to understand if we're going to go down or not. So what happens is a high of the supply zone is being swept. I don't think that whoever is moving the market, if let's consider it as being one big entity, would go as far as pushing the price all the way up to the supply zone and then even up just to see if maybe there is some stops out there. It makes no sense, because the amount of money you would have to put in place to see if there is actual orders.
The risk reward of it, yes.
And you can't be sure there's orders there. So I wouldn't say they are going up with that intention, but maybe if price has rebalanced a phase of very, very harsh market direction, and now it's rebalancing towards fair value again, which is where price started, so the origin point of the impulse, then I would say if we're maybe staying, again, it depends on the time frame, but if we're staying sometime on the supply zone and then the last up thrust before going down, that could be, that you could see that as some sort of manipulation, but I wouldn't say is the main driver of the next movement. It's more because if you also see volume-wise, the least amount of volume is played in spikes. Most amount of volume is played in the distribution phase. So there's a lot of volume going on in consolidation. The up thrust, I would see it like as a little fart, you know, to just, let's see, but you know, whatever. Like it's not crucial for me for directional bias on the meaning aspect of it. But statistically, which is what people should be interested in mostly for their trading process, there can be a good statistical edge to a high being swept and following opposite direction.
That makes sense. So one of your strategies was just actually selling after the sweep to fill the book.
Correct. It's a very short-term
and
trade.
that in pips, let's say, I know it's futures, but it could be 10 pips, 15 pips max. It's a very small,
average,
quick move.
The average was, the minimum I would take was 7 ticks.
Okay.
To usually a maximum of 15, because it's rare that it will go way higher than that. If that happens, I'm putting like my house on it, whatever. Like it's like I'm gonna sell my house and put all of the money into that trade if it goes more, because I know the statistical edge. The more volume there is in a stop run, the higher the likelihood that it's going to rebalance it out. It's like up. If you're going up to this is crazy sauce. I'm not sure why I'm giving it away like this, but after 1.5 thousand contracts in a 1 minute candle, he's like the probabilities get increasingly higher, like 80%, that it's going to reverse and rebalance that.
How interesting.
Yeah.
Last kind of question I want to ask on this topic of order flow. When price is arriving to a significant level, again, let's just call it supply for now, you can have a lot of momentum coming into it, and there could be a difference between absorption and exhaustion.
Correct.
How can you read that? Because that's going to be indicative of what's going to happen next. Is it going to blow through that supply level, or is it going to respect? How can you see that mechanics not only in consolidation and price action and therefore movement after, but actually in the order flow as well?
I mean, Umar Ashraf has done so many great examples about this. He's a great order flow understander. He understands the if you listen to all of his video, this is the kind of shit he talks about, and a lot of professionals are talking about, by the way. Most professionals I've known from the professional side of the world that are not born and raised in the retail space use these kind of charts and understanding of market mechanics, which is one of the reasons why I've shifted eventually. But what happens in a supply zone usually, or in a place where there's more liquidity, because you have to understand, the idea that markets are driven by liquidity is correct. When an ICT traders, I've seen some reels recently, and they say liquidity is the driver of markets, so everything is about liquidity, and I'm so agreeing with that. But then they start saying, what is liquidity? So above a high there's stops, below a high there is stops, so they are sweeping. No, absolutely fucking not. Liquidity is everywhere. It's not below a low, it's not above a high. Liquidity is absolutely everywhere. The lowest amount of liquidity is above highs and below lows. So that's why I think that's not the reason why price is moving, to go above or below a high to get some stops or to get some liquidity, because the amount of liquidity there is in the middle is way higher. If by liquidity we mean all kind of orders, because liquidity is orders. So if we're getting into a supply zone, most likely what's going on is we are starting from somewhere where there was a balance, okay, where market was agreeing on a price. And then something happened in the perception of the market, or in the perception of the fundamentals of the asset, or simple and really basic portfolio rebalancing of huge operators. So we're rebalancing back to a previous level, or we're just finding a previous level on our way up. Why are we going up is the question. First question we should ask, why are we going up? We're going up because we want to find liquidity. Liquidity is, the definition of liquidity is ease of transactions. It has to be easy for us, big participant, to trade without impacting price. That's all of the market is. That's auction market theory in one sentence. So what these big participants will do is find a place where it's easy to trade, and usually in a supply zone, they will find that, a place where it's easy to trade. So the first thing that they will find, if they're aggressive buyers, because aggressive buyers are moving price up, they will find a wall of passive sellers. And sellers which are going to absorb all the buying pressure, all the buying inertia. Doesn't mean that in this period there's more buyers than sellers. There's just more aggressive buyers than aggressive sellers. Aggressive buyers were accepting worse prices. So here, you would probably see in the footprints a lot of absorptions in the higher parts of the range. So these are all sell limit orders that are being put in the market gradually with fractional orders and icebergs and blah, 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 what we talked about. And they're going to form some level of walls, which usually, if you're in an M5 time frame, is going to be, I would say, a range of 5 to 10 ticks, where you will see a lot of buyers trying to push up, but they can't because there's all these passive sellers blocking the price from going up. So that's the first thing I would look for if I want to look for a reversal on a supply zone. Is there passive sellers putting the shields there, and pushing back all these buy inertia? The second thing I would look for is, are aggressive sellers coming in? So not just passive sellers that are holding the price, but aggressive sellers which are willing to pay lower and lower prices to all these new buyers. And when I see that, maybe during a breakout or after a sweep, there is a candle with a very high sell delta, which is the mathematical measure of market pressure, then I would say, okay, aggressive sellers are pushing down. If the delta of the candle is above 10% of 25%, that range is the aggressive candle kind of typical amount, then that's a really good sign. Way better than an engulfing candle.
And when you, let's say that what you just described exactly happened, what would price action look like? Just in candles.
An engulfing candle.
Okay.
Definitely. You would see price going slower, maybe having a spike, not necessarily, but maybe having a spike up if there's a stop run, and then you would see an engulfing candle. So what OrderFlow would give you in this situation is absolute, let's say 90% certainty on what's actually going on, because that's the main point. If I want the traders who are watching us to take something out of this on OrderFlow and level 2 data, is the stuff you're trying to figure out is the same. You're just getting more objective about it. You're just getting 100% certainty that in that big sell candles, sellers are dominating, because it's not always like that. Buyers may be dominating in a sell candle, and you cannot see it. It's not extremely highly likely that will happen, but there's some instances in which it does. And what OrderFlow is giving you, what level 2 data or footprints is giving you, is you're seeing what the market is doing. You're actually seeing it.
Yeah, I can see how important or imperative it is.
Yeah.
Last question before we wrap up, because this has been an OrderFlow masterclass.
Yeah, by the way.
And I wasn't expecting it, but I'm glad, actually, because it's super useful. And I'm sure people are just taking notes. Last question I have is, obviously, we did the podcast with Patrick Nilm, who's the trading world champion on Robin's World Cup, 2-time on the leaderboard. So the podcast I did with him, I regret not asking it, but I can ask you, because I know you guys are associated and work together. He mentioned that he's trading CFD Forex. But obviously in CFD Forex, there's not the order book as we discussed. Yeah. So he's using OrderFlow in futures and then taking a decision in FX, as opposed to what you're describing, which is seeing the order flow in futures and then trading the futures. Why is he choosing, as a world champion, to trade FX still?
Commissions. This decision is purely based out of commission, because if you're a day trader, or as he defined himself, intraday swing traders, so he's taking big movement intraday. Okay. Commissions in futures, Robin's World Cup trading championships yearly are not worth it at all. Zero.
Simply because of that.
Simply because of that. In his professional world, in his professional trading, because he's a portfolio manager. They're managing an actively managed certificate in, I don't remember if it's Switzerland or something. The trade ideas they have are executed in futures market. Because it's the best. It's just the best. There's no spread markup. There's a spread, of course, the price you pay between the difference in bid and ask, the best bid and the best ask. But what's the point with CFDs is there's a markup on the spread, so there's more spread. That's why also I chose to shift from CFDs to OrderFlow in the first place. And people should also know that right now I'm not focusing on day trading anymore. I'm focusing more on swing trading. So my main source of cash flow isn't day trading anymore as it used to be. It's more software, education, YouTube, and I'm shifting more to the entrepreneurial side of trading, or let's say entrepreneurial side of life in the trading space, and using then macroeconomics and more swing trading. So all this order flow stuff, unfortunately, that I was, I'm not implementing it anymore as much as I used to.
Well, I think you're here for a couple of weeks or a bit of time, so I think we're going to run a part 2. I really enjoyed this episode, and I know there's so much more to unpack with macroeconomics and then obviously just life in general, entrepreneurship, etc. So we're on a part 2, but epic episode, bro. And I hope this one goes crazy views-wise, and I hope people learned a lot about Andrea. Thank you for joining.
Thank you very much. Thank you.
Good stuff, bro. That was sick, man. That was sick. I really enjoyed that.